If you have retired in the last few years, or you are about to, there is a list sitting inside Hmrc right now of things they expect you to have done. Not things they recommend. Not things that would be nice to get round to eventually. Serious. Things that, if you miss them, can leave you owing money, missing out on money, or quietly building a problem that only surfaces years later when it is far harder to fix. And here is the part that should genuinely concern you. Concerned. Nobody sends you that list. There's no welcome pack that arrives the week you retire. No letter that says, here are the 8 things you now need to handle. Hmrc simply assumes you already know, and if you do not, the consequences land on you, not on them. I have gone through the actual obligations, the real reporting duties, and the genuine traps that catch newly retired people every single year. And by the end of this video, you will know exactly what Hmrc expects of you, which of these 8 you have very likely already missed, and the simple steps to put each one right before it costs you anything more. I'm James Hartley, and before I go a single sentence further, do me a favor and hit subscribe and turn on the bell. The rules around tax and retirement income shift constantly, and when they do, nobody from Hmrc rings you up to walk you through it. I take these the moment they change and turn them into plain English so you are never the one caught out. Hit subscribe, and let's get into this properly. The first thing on this list sounds almost too obvious to mention, and that is exactly why so many people skip it entirely. When you stop working, Hmrc does not automatically know that your income has changed, unless something tells them. If you were employed, your employer's final submission gives them part of the picture. But if you were self-employed, or your income situation is more complicated than a single employer, Hmrc can carry on assuming your earnings are roughly what they always were, right up until you tell them otherwise. This matters because your tax code, the figure that determines how much is taken from your pension income before it reaches you, is built on assumptions about your total income for the year. If those assumptions are wrong, because Hmrc still thinks you are earning a salary you no longer receive, you can end up significantly overtaxed on your pension income for months before anyone notices. The fix is straightforward. As soon as you retire, update your situation through your personal tax account online or by contacting Hmrc directly, and make sure your circumstances are reflected accurately rather than assumed. The second thing follows directly from the first, and it catches an enormous number of newly retired people in the very first year. When a pension provider starts paying you, they apply a tax code to work out how much to deduct. In many cases, especially in that first year, an emergency tax code gets applied automatically, which can result in considerably more tax being taken than you actually owe. This is not malicious. It is simply how the system defaults when it does not yet have a clear picture of your total annual income. The amount overtaxed in these situations is not trivial. People drawing a private pension for the first time have ended up paying hundreds, sometimes well over £1,000, more than they should have in that opening year alone, money that sits with Hmrc until somebody notices and claims it back. Hmrc will not necessarily catch this for you automatically within a reasonable time frame. You need to check your tax code on your first pension payment. Compare it against what your actual total income for the year is likely to be. And if something looks wrong, contact Hmrc directly rather than assuming it will sort itself out. The third obligation catches people with what feels like an entirely ordinary, sensible retirement setup, several smaller pensions built up over a working life rather than one large one. Hmrc needs to know about every source of pension income you have, because your tax-free personal allowance is applied once across your total income, not once per pension. If you have a state pension, a workplace pension, and perhaps a smaller private pension on top, all three need to be accounted for together when working out what tax, if any, is due. The trap here is that each pension provider only sees their own payments to you. They do not automatically know what you are receiving from elsewhere. If Hmrc's records are not properly updated to reflect all of your income sources together, you can end up either underpaying tax, which then gets clawed back later in a way that feels sudden and unfair, or overpaying because each source is being taxed as though it were your only income. Make sure Hmrc has a complete and current picture of every pension you receive, not just the main one, so your tax code is calculated against your true total income rather than a partial guess. The fourth thing surprises a huge number of retired people because it touches money that feels completely separate from pensions altogether. In retirement, many people finally have meaningful savings sitting in accounts earning interest, sometimes for the first time in years, as money from a pension lump sum, an inheritance, or simply decades of careful saving builds up. That interest is taxable income, and you have a personal savings allowance that determines how much of it you can receive tax-free before Hmrc expects a share. The complication is that for most people, banks no longer deduct tax on interest automatically the way they once did. The responsibility sits with you to know whether your total interest across all your accounts has crossed your allowance, and if it has, to make sure Hmrc is aware so the correct tax is collected, usually through an adjustment to your tax code rather than a separate tax return for most people. With interest rates higher than they have been for a long stretch of recent years, this is catching far more retired savers than it used to, often people who never had to think about savings tax in their working life, and simply assume it still does not apply to them. The fifth obligation is more serious, because missing it carries automatic penalties that have nothing to do with how much tax you actually owe. If your retirement income picture becomes more complex, for example, if you continue some self-employed work alongside your pension, you have significant rental income, or your total income from all sources pushes you into territory where Hmrc requires a full tax return, you are required to register for self-assessment and file on time every year. The deadline for registering, if you are newly required to file, is the 5th of October following the end of the tax year in which the requirement began. Miss that registration deadline, and miss the filing deadline that follows in January, and the penalties begin automatically, regardless of whether you actually owed any tax at all once everything was calculated. Many newly retired people genuinely do not realize their situation has tipped into self-assessment territory until a penalty notice arrives, simply because nothing about retirement feels like it should require the same paperwork as running a business. The sixth thing connects closely to the fifth, and it catches a specific and growing group of retired people directly. A lot of people do not stop working entirely the moment they retire. They take on consulting work, turn a hobby into a small income, or do occasional paid work in a field they spent their career in. Whatever the nature of it, if you are earning money this way, and it amounts to more than a small incidental amount, Hmrc expects you to register it as self-employment, and declare the income. The threshold that allows truly small amounts of trading income to go undeclared is modest, currently in the region of £1,000 a year, through what is called the trading allowance. Beyond that figure, the income needs to be properly declared, even if the amount feels small in the context of your overall retirement finances. People who would never dream of being dishonest about their income often genuinely do not realize that the modest sum they earn from occasional work counts in the same category as running a business in Hmrc's eyes. The seventh item is different from the rest of this list because it is not something Hmrc expects you to report. It is something Hmrc expects you to claim, and the fact that you have to actively ask for it is exactly why so many eligible couples never receive it. If you are married or in a civil partnership, and one of you has income below the personal allowance while the other is a basic rate taxpayer, you may be entitled to transfer a portion of the unused allowance between you, reducing the higher earner's tax bill. For couples where one partner has fully retired with little or no income and the other still has pension or part-time earnings, this can be worth several £100s a year, every year, for as long as you remain eligible. It is not applied automatically under any circumstances. You have to make the claim yourself, and it can also be backdated for a number of years if you qualified previously and never claimed, which is exactly the kind of detail that turns a modest annual saving into a genuine lump sum once you finally do apply. The eighth and final thing is less a single action and more an ongoing responsibility that follows you through the whole of your retirement, and it ties everything else on this list together. Hmrc's records are only ever as accurate as the information you give them. Every time your circumstances change after retirement, drawing a pension lump sum, starting some part-time work, your savings crossing into taxable territory, a change to your marital status, the responsibility to update Hmrc sits with you, not with them. The system does not proactively check whether the picture it holds of your finances still matches reality. It simply continues calculating your tax based on whatever it was last told, correct or not, until you tell it otherwise. Treating this as a one-time conversation at the point of retirement, rather than an ongoing responsibility, is exactly how small mismatches turn into years of incorrect tax calculations that eventually have to be unwound, often at a cost. I want to be honest with you about why this list exists at all because I think it matters. Hmrc's systems are built to process information you give them. They are not built to chase you down and explain what you might be missing. There is no requirement anywhere in the system for them to proactively walk every newly retired person through these 8 obligations, and in practice, they very rarely do beyond the most generic, easy-to-miss guidance buried on a website most people never think to visit. The people who get caught out by this are almost never trying to avoid anything. They are simply retired people who assumed, reasonably enough, that the same straightforward tax situation they had during their working life would simply continue without anything further needed from them. Retirement does not work that way, and the silence from Hmrc on that point is exactly what catches so many honest people unprepared. So let me bring this together into something you can actually act on. Go through these 8 points honestly against your own situation. Have you formally updated Hmrc that you have retired? Have you checked your tax code against your first pension payments? Does Hmrc have a complete picture of every pension you receive? Is your savings interest within your allowance, and if not, have you reported it? Does your situation now require self-assessment? And if so, have you registered? Is any work you are still doing properly declared? Are you and your spouse making use of marriage allowance if you qualify? And do you have a habit of updating Hmrc whenever something in your finances changes? If even one of these does not have a confident yes attached to it, that is something worth dealing with this week, rather than letting it sit. You can check and update most of these directly through your personal tax account on the gov.uk website, and for anything that feels complicated, free guidance is available through Citizens Advice or a qualified accountant if your situation has more moving parts than most. You now know the 8 things Hmrc genuinely expects of you the moment you retire. Most people watching this had no idea that even half of this list existed an hour ago. That knowledge, acted on properly, is the difference between a retirement where your tax affairs quietly look after themselves and one where small oversights slowly turn into real money lost. If this has been useful to you, please share it with anyone you know who has retired recently or is about to, because almost nobody explains any of this clearly, and it could save them a genuine headache further down the line. Hit subscribe and stay close, because I will keep bringing you exactly this kind of thing the moment it matters. Video